The mortgage market in the UK is expected to be booming in 2026, according to Moneyfacts, who are one of the leading suppliers of UK financial services data. So what are some of the key reasons they've pointed to as to why they think this is the case? Well, firstly, at the moment, the amount of mortgage products on offer is around 18, which is the highest we've seen in many years now. There's also around 1.8 million borrowers on 2 to 5 year fixed deals, representing about 80% of the mortgage market, meaning that millions of people are going to be looking to refinance or remortgage their properties within the coming years, meaning that all of the mortgage providers out there are going to be in strong competition for these buyers, as they're going to want to grab as much market share as possible, and often that means they're going to be competing on rates, which in theory should help to drive rates down. Now, on the interest rates piece, we've seen the Bank of England gradually reduce the Bank of England base rate over the last year or so, and that's meant the mortgage rates have followed suit and started to drop as well. And so in August of 2025, we saw mortgage rates fall below 5% for the first time since Liz Truss's mini budget in 2022, which caused rates to go skyrocketing up. And since then, mortgage rates have fallen even further, with the likes of HSBC and Barclays and some of the other big lenders cutting rates this week down to as low as nearly 3.5% for some mortgage products. And now, Moneyfacts expects further rate cuts from the Bank of England in 2026 to then cause mortgage rates to fall even further this year. So look out for potential further rate cuts from some of the big lenders out there into 2026. And also some other initiatives that have been brought in more recently have helped to stimulate demand, which is expected to continue into 2026 according to Moneyfacts. So for example, lenders are starting to relax some of their requirements when it comes to taking out a mortgage, meaning that it's more accessible to more people. And then you've got, for example, the income test. So normally lenders will expect you to be able to take out a mortgage of around 4 times your earnings, but some lenders have actually increased this to around 6 times earnings, making it again more affordable for some people to take out a mortgage. And other clever initiatives like the joint borrower sole proprietor mortgage, which is where a lot of first-time buyers are making use of this special mortgage, which allows essentially 2 people to take out a mortgage, but with only one homeowner. So you could have, for example, someone in their early 20s wants to take out a mortgage but can't quite afford it, and so they take out one of these special mortgages with their parents, meaning that them and their parents are included in the affordability calculations. So you get essentially potentially 3 incomes going into a mortgage, which helps the person in their early 20s to buy this particular house. But what's great about these mortgages is that technically there's still only one owner of the property, and this means that in this case, say this person in their early 20s was a first-time buyer, then they would still get their first-time buyer's stamp duty relief, meaning that again it should make it more affordable for younger people and first-time buyers in general to buy property. So comment below what you think. Do you agree with Moneyfacts' prediction that it will be a booming market in 2026, or will potentially inflation increase again like we saw a few years ago, meaning that rates will have to then go up, causing the property market to stagnate?